For those new to the world of cryptocurrencies, understanding Bitcoin exchange-traded funds, ETFs, can be a bit complex. In this beginner-friendly guide, we'll explain what Bitcoin ETFs are, how they work, their benefits, and alternative investment options. What is a Bitcoin ETF, and how does it work? ETFs, or exchange-traded funds, are investment options that combine the characteristics of mutual funds, stocks, and bonds. They are collections of assets whose shares are traded on stock markets throughout the day. Like stocks, ETFs have varying prices based on market supply and demand. Bitcoin ETFs, unlike cryptocurrencies traded on crypto exchanges, track the value of Bitcoin and trade on traditional stock exchanges. They offer investors exposure to Bitcoin without the need to navigate cryptocurrency exchanges. One example of a Bitcoin ETF is the ProShares Bitcoin Strategy ETF traded on the NYSE. It's important to note that the U.S. Securities and Exchange Commission (SEC) has rejected multiple proposals for Bitcoin ETFs, citing concerns about the crypto market's lack of regulation. Most Bitcoin ETFs use futures contracts to replicate the cryptocurrency's performance. Futures allow investors to buy or sell cryptocurrencies at predetermined prices in the future. This can provide some protection against market volatility. Investors can also gain exposure to Bitcoin by investing in cryptocurrency and blockchain companies that support the crypto market. Bitcoin futures and Bitcoin spot ETFs. Bitcoin futures ETFs and Bitcoin spot ETFs differ in how they represent the value of cryptocurrencies. These represent the value of a cryptocurrency based on contract conditions. When you buy or sell futures, you don't own the underlying cryptocurrency itself. Instead, you hold a contract to buy or sell it in the future. This approach offers protection against market fluctuations, but doesn't allow you to use or stake the actual cryptocurrency. Spot ETFs, spot ETFs, on the other hand, involve direct ownership of the cryptocurrency. When you buy a spot ETF, you gain ownership of the cryptocurrency itself. This is similar to owning cryptocurrencies on a crypto exchange. One key difference is that futures ETFs can sometimes underperform because they are based on derivative contracts, while spot ETFs track the actual cryptocurrency price more accurately. How do Bitcoin futures ETFs work? Investing in Bitcoin futures ETFs means agreeing to buy or sell Bitcoin at a specific price on a predetermined date, regardless of market conditions. The agreed-upon date for contract settlement is known as the expiration date. Depending on market conditions, the party that agrees to buy Bitcoin at the contract's expiration may do so at a discount or premium. This price difference is known as contango, when futures are priced higher than the spot price, or backwardation, when futures are priced lower than the spot price. Contango and backwardation can affect the performance of Bitcoin futures ETFs, impacting the returns for investors. How do Bitcoin spot ETFs work? Bitcoin spot ETFs, which involve direct ownership of the cryptocurrency, provide a more accurate reflection of Bitcoin's current market price. However, there are currently no spot Bitcoin mutual funds or ETFs available in the United States. In contrast, Bitcoin futures ETFs trade on traditional exchanges and are regulated by the Commodity Futures Trading Commission. Spot ETFs are more akin to owning the actual cryptocurrency, but they are not currently available in the U.S. Investing in Bitcoin ETFs. In the United States, you can invest in Bitcoin ETFs like the Bitcoin Strategy ETF ITO listed on the Mercantile Exchange of Chicago. To invest in a Bitcoin ETF, you'll need to open a brokerage account with a platform like Robinhood or Fidelity. Once you have an account, you can use either a market order to buy shares at the current market price or a limit order to specify the maximum price you're willing to pay. Investing in a Bitcoin ETF allows you to gain exposure to Bitcoin without owning the actual cryptocurrency. Pros and cons of Bitcoin ETFs. Bitcoin ETFs offer several advantages, including exposure to Bitcoin without the complexities of crypto exchanges, diversification through a combination of various assets, tax efficiency as they are regulated by the SEC. However, they also have downsides: lack of accuracy in price tracking, potential price inaccuracies due to contango or backwardation, inability to exchange for other cryptocurrencies. Alternatives to Bitcoin ETFs. If Bitcoin ETFs aren't your preferred investment choice, you can invest directly in cryptocurrencies like Bitcoin or Ether on crypto exchanges. Consider investing in stocks of public cryptocurrency exchanges like Coinbase. Explore blockchain ETFs, which track companies invested in blockchain technology. Bitcoin ETFs. Blockchain ETFs. While Bitcoin ETFs track the price of Bitcoin, blockchain ETFs focus on companies invested in blockchain technology. The two serve different purposes, with Bitcoin ETFs aimed at providing exposure to the cryptocurrency market, while blockchain ETFs offer exposure to blockchain-related stocks. The road ahead. The future of Bitcoin ETFs is uncertain but promising. More applications for spot-based Bitcoin ETFs may emerge, along with increased regulatory approvals for futures-based ETFs. However, investing in Bitcoin ETFs carries risks, and it's essential to understand these before diving into this type of investment. Remember that cryptocurrency investments can be volatile, so it's crucial to do your research and consider your risk tolerance before investing in Bitcoin ETFs or any other crypto-related assets.
To dive deeper into this topic, watch this next video we created for you. Click here and make sure to hit the like button and subscribe to stay updated with our latest content. Your journey into financial freedom begins here.